you're ending the year and as you're starting the year, some very important things that you do some game planning. A lot of people they pick one of their most important goals, let's say it's trading, and then they go through game planning on that side, which is, the outline of milestones and goals that you're looking to have. What I would like everybody here to do is don't sacrifice any part of your life. So, for example, maybe your priorities are going to be one part family, one part, business and professional, and then one part financial, which is going to be your trading. And then maybe you want to learn a skill set going into next year, whether it be another language, whether it be how to do real estate, whether it be starting your own business or understanding taxes. So before you go into 2024, if you really want to have a result that you can expect, because we don't do things by chance. Like the FX Summit does not happen by chance. You have to get the entire Forex industry to cooperate for 3 days without any problems or issues. You have to get everybody in the Forex industry to understand the importance of building something that's a center place for everyone to collaborate. And it's a very tough thing to do, especially with the level of detail and specificity that goes into the post-conference events, VIPs, flying out all the speakers from around the world, running the entire event, making sure the coordination is there. So if you look at all the things that we're able to accomplish year over year, take my trading aside and just look at the real world impact that we're having. None of this happens by accident. You have to do it using milestones. So before we go into wealth management today, which is really the bedrock of what we're going to talk about, I want all of you to start looking at those different facets of your life, whether it be your personal achievement, your professional achievement, your financial achievement, your spiritual achievement, and your health achievement. Let me go through those again. You have your professional goals. You have your financial goals. You have goals regarding your health, goals regarding relationships, family, things in that nature, and then skill set goals. If you're not growing in terms of the skills that you have and the skills you're acquiring, you can't expect to change your life. If you've had the same skill sets for 5 years and that has not led you to the life that you want, with the distance between the goals you want and the life you have are the skills required to get there. Skills and knowledge are the vehicle between what you want and what you have. You want to have $1 million in funding next year. Okay? That's your goal. Where are you right now? Let's say you only have $100,000 account. The distance between the 100,000 in management that you have and the $1 million that you want are the skills necessary to get more accounts, not blow them, and keep getting payouts. Okay? Maybe some of you guys are great at trading, but you have not mastered the skill set of not blowing the money back. Maybe you guys are great at making money, but you never make it to your first payout because of impatience or because of a lack of self-discipline. So the skill set difference between you getting the goals and not having the goals is you learning how to keep money. So identifying the skill sets that you're lacking in that are going to help you to your future success, this is what 2024 needs to look like for you. You can't have new results doing the same actions or using the same exact skill sets. Deal? Put a one in the chat if you guys understand the basics of 2024 game planning, understanding the different, facets that you're going to have to focus on. And here's the reality, because everybody tells you can have everything in the world. You can have everything that you want if you put your mind to it. Let me give you guys some reality here. You can have anything that you want, but you can't have everything because time is limited. Our effort is limited, and I wish we had an untapped amount of time in the day and memory formation in the day. No, we got to pick and choose our priorities. So you're going to have these different goals, but you can't say, I want to have a six pack and be built like who's the guy that played Thor? Yeah, I want to be built like the guy that played Thor. And I want to have the most incredible, beautiful, and well-run family. And I want to have the ultimate business success in every aspect of my life. And I want to have, whoa, whoa, whoa. Over time, can you curate a life where you have all those things? Of course you can. But there are seasons where you have to have priority. And right now, if the priority is, let me give you as an example. It all starts with your physical health. Okay? If you're out of shape, if you're always tired, if you're always eating crap, if you're always hungover, if you're always having a drink before you go to sleep and you're waking up with no sense of clarity, if you're always eating crap just other people around you are eating, you don't take any control over a diet that will make you the most advantageous diet for you, you're not going to have the results you want. You're not even going to make it to step 2. Forget the family goals. You're going to show up from work tired. You're going to show up from work not wanting to pour into your family. So it all starts with priorities. If you're not in a healthy state of mind, that's the first place you want to start. If you're not in a healthy state of living, it's the first place you want to start. Now, if you don't have any money, let's say that you finally got your health right, you are exercising on a regular basis, you're eating a diet that's productive for your success. But if you don't have any money, that's going to be the next step. You have to improve your earning potential. So you can either become better at your job, maybe get a certification or something so you can up your raise or you can up your pay. You might have to start shopping around because I know it's tough to go apply for a new job. You already have one, it's working for you. But you have skill sets at this job and you have 50,000 competing companies in your industry. One of them is going to pay you more. And all it takes is you having the self-confidence to go shop around and say, for the same skill sets I have, and for the same market environment that I'm operating under, can I go shop around for a better deal? And a lot of people don't do this stuff. I don't even know why. What if you shopped around for a better internet company? What if you shopped around for a better healthcare provider? What if you shopped around for a better insurance company? You could save yourself $100 here, $100 here, $100 here, and you'd have a much more robust budget every month. But most people don't want to pick up the phone and call. Call Geico. 15 minutes could save you 15%. Call them. Say, yo, here's my current insurance plan. Here's what I get. Could you beat this? You lose $0 from shopping around. Zero. They all want your money. They all want the sale. Right? So take your life into your own hands by understanding what it's going to take for your success. It's going to be the physical, it's going to be the outline, it's going to be the income earning potential, and we'll go through all of those. Now, today's call is going to be mostly focused on wealth management and investing. Why? Because that used to be my profession before I was a full-time day trader. For those of you guys who don't know who I am, my name is Roy Dunya. I am a full-time day trader, and I was previously a wealth manager and a U.S. licensed broker dealer, meaning I used to give financial advice to my clients. So it would all start with financial planning, which is how to look at your future and how to figure out what you should be investing in. The second one is I could recommend specific investments for my clients because I was a Series 7 investment advisor, and I could look through insurance products, I could look through retirement assets, and I could help you figure out what you should be buying to help meet your goals. And then as a U.S. licensed broker dealer, I was able to put in those trades for my clients on their behalf. So I kind of had a full stack. Let me go to the SEC website here. Broker check, just to kind of show you guys the different licensing that is required to be an investment advisor and a U.S. licensed broker dealer. Look up here quick. So these registrations are no longer active because I've had 3 years removed, or not 3 years, but it's been about 2 years removed from the job. And so these are not currently active. As soon as we start our own fund, I'll be able to do the continuing education and reinstate these licenses. Ideally without having to retake the exams, but if I got to retake them, so be it. The Securities Industries Essentials, the SIE, allowed me to become basically a certified financial planner. Financial planning is understanding what your life path is going to look like and what your financial goals are. A Series 7, the General Securities Rep, is basically a wealth advisor. So I'm able to recommend specific securities and specific investments into your plan that will help you reach your goals. And then, of course, the Series 66, this Unified Combined State Law exam, this allowed me to take trades on behalf of my clients. So they would give me the money, I would be managing it for them, and I'd be able to put these trades into the market for them to build their $1 million portfolio. So this is my credibility here. This is kind of my background. And what I'm doing today is showing you the same conversation that I would have with a wealth management client to give all of you that advantage for success. All right. So let's talk about the very basics. We're going to start this. This is going to be a 5-part presentation, and I really want you guys to take notes. After this, you should never have a question about what you should be doing. It's just a question of, are you doing enough to get there? Okay. So here are the most important things. This is step 1. Okay. There are 4 facets to your investments and to building the perfect portfolio. Whenever I would sit down at a dinner, by the way, people would ask me, Roy, what stock should I invest in? I'd have to remind them, I'm not a stock picker. I'm not here to give you the best stock advice. What I'm here to do is help everyone understand your financial goals and your situation is different than everybody else on this call. And so when somebody gives general investment advice, You should never, and first off, I have to do a disclaimer, which is this is not financial advice. Ladies and gentlemen, please do your own research and please consult a licensed financial professional. Please consult a licensed financial professional before making any investment decisions for yourself. Okay? So everybody is different. Here's the four facets that you should take into a consideration when you're building your portfolio. Number one is your goals. Number two is the duration, like how long do you expect this? How long do you have to meet these goals? Number three is going to be your risk tolerance. Then number four is going to be fees and taxes. Okay. Now, I am going to say some stuff that you guys are going to have to write down next to some of these terms. And let me actually just remove a few things here. First, let me show the captions. And then let me erase some of these annotations that some people very kindly drew on the screen. Okay. Don't write on my screen, guys. It's not cool. All right. So goals. If someone's young, they typically have different goals than somebody who's in the retirement age. So if you're fresh out of college, your goals typically look like you want to pay off your college debt, you want to get your first house. If you're in that middle period where you have a significant other, you're looking to get married, so you're trying to fund a wedding, you're trying to fund your life together, your first purchase. Now in the middle phases, you have different sets of goals again. Maybe you just had kids, you want to start planning early to send them to college. So even if they don't want to go to college, you should still have a fund for them that when that time comes, they don't have to take on massive debt. You guys don't have to pay out of pocket for some of those expenses. And if you invest enough money early, a small amount of money early, and allow it to grow over the 18 years of that child's life, by the time that they go to college, they have their entire college paid off. This whole idea of privilege in this country, I realized that privilege is actually not passing down physical assets, it's passing down education. If you pass down an education to know that when, like, you have an obligation to pay off your kids' tuition before they even hit college. And in the first 5 to 7 years of that kid's life, if you're putting in enough money into one of these state-sponsored plans, they will have enough money at the end. There's different kinds of investments to send kids to school. There's some that they have to use it specifically for school. There's some that they can use the money for whatever. If they decide not to go to college, the money is still theirs. Okay, so you can give your children a head start just through this awareness of knowing that this is your obligation. So duration is different for a lot of people. If you're closer to retirement age, you're 5 years away from retirement. Your goals might be, don't mess it up, right? Preserve the money until I retire because I don't want to lose this because I'm so close. I want to buy a retirement home and I want to make sure that my grandchildren are set up for whatever. Those individuals near retirement also start thinking about estate planning, which is what happens after you pass away. Your estate is basically your entire portfolio of what you own. The real estate you own, the money you have in bank accounts, the money you have with brokers. This is your estate. And your estate, this is what you transfer over to your children. This is what you transfer over to the next generation. So estate planning, how to reduce your taxable liability when you go to pass your estate over. Because there are death taxes and there are estate taxes that you'll have to pay when you want to give your money to your kids. But what I would do for my clients is I would make sure that we set up a portfolio for them where those would be taken care of. I'll give you a slight example. This is not advice for anybody here, but this is one of the things that I would do for my clients. If somebody was going to retire and then they had a taxable liability when they passed away to pass on their money, they had a taxable liability of $100,000. So they'd have to pay 100 grand of all their money straight to taxes. We would open up an investment like an annuity, which is an insurance product that upon their death, they would get paid out a death benefit of at least $100,000. So when they passed away, the insurance policy kicks in, they get the 100 grand and they can pay off the taxable liability, their estate tax, with this one check. So their kids never get taxed on that money. You get to pass it all over because you worked your whole life for it. Uncle Sam wants their cut. You're going to make sure that all the money makes it to the people who it belongs to. Okay? So duration is very important. Goals, very important. The way that we look at goals, usually it's in different categories. You can have your life goals, which is you want to start a business. You want to go travel the world. You want to go, okay? You have your family goals. So whether that be buying a house for your wife, sending your kids to school, long-term planning. You have your retirement goals. What do you want your retirement to look like? You want to be making the same amount of money every month? You want to be making more? It's very important to look at the duration of these goals because all of you know that the more money you make in income, the more you get taxed. So the goal when you retire is actually you want your income to be as low as possible. You want it to be at zero. What most people do is as they get closer to retirement, that's when you're getting paid the most at your job because you've had the most amount of raises, you've had the most amount of promotions. Now you're getting taxed 40% for all the hard work that you're doing. When you retire, you want your income on paper to be zero. That way they can't tax you. But you want your assets to be so big, you want your investment assets to be so big that the distributions you're getting every month or every quarter from those assets are going to maintain your lifestyle. So you don't want to just be a doctor who just keeps making more and more and more and more because they're just going to keep taxing you. So at some point you want to reduce the amount of income you have over time and increase the amount of assets you have over time. Make sense? So you have your family goals, long-term planning, you have your conspicuous spending, right? I want to get a car when I retire. I want the Lamborghini, right? So you have to have these goals. Duration is looked at in three parts: short-term, long-term, and medium-term, like intermediate. Your short-term goals is going to be, okay, I want to pay off this credit card debt. I want to start investing in my insurance fund, and I want to, start making more money. Your intermediate term goals is in 5 years, I want to buy a house. In 8 years, my kids are going to go to college. In 10 years, my wife and I want to move. And then long-term goals is going to be retirement. So on retirement, how do I want my life to look like? How much freedom do I want to have to travel and do all these things? That's going to be your longer term planning for the goals. Number three is your risk tolerance. Okay. Risk tolerance goes conservative, moderate, and aggressive. If you're young, typically you're more on the aggressive side. Why? Because we don't have that much to lose. We're young. I don't have that much to lose, and I have a lot to gain and a lot of room to make up. So I can put my money in more risky assets like stocks, like crypto, like some of these companies that maybe have a shot, maybe don't. When you're closer to retirement age, you don't have that same luxury. You're not going to invest in cryptos 3 years before you're supposed to retire. Because imagine you put some money in Bitcoin and then that's the year where it crashes. You can't retire that year. You have to make the sacrifice. So risk tolerance for me is going to be very important. And this also applies to trading. Some of you guys want to trade like the full margin traders, but you don't have the same risk tolerance. Every time you lose, you get down on yourself and you start thinking about life and you start looking at God for why. That's not you. Don't try and trade like the person who can lose $1 million and didn't even break his sweat. Right? They got a few screws loose. And so that's why they have that high tolerance. But typically for investing, risk tolerance comes from the duration or like where you are in your life. Near retirement folks, typically the lowest risk. I ain't messing up their $1 million right 2 years before they retire. I'm putting it in government bonds, I'm putting it in corporate treasuries, and I'm putting it in fixed income assets that are very safe. Now, the younger person, better you got $1,000. All right. That $1,000 is not going to do too much for you. Let's go ahead and get a little bit more aggressive here, and let's go put it into things that have a higher return. Okay. Risk tolerance is important. And last but not least is fees and taxes. This is the part that nobody pays attention to, and that's why I have these examples here. I'm going to show you the difference between if you're making 5% versus 6%, what your money's going to look like, and how big of a difference it makes. Okay? So fees and taxes is the hidden secret of investing. And this is the scam of Wall Street. So in case you guys wanted some insider baseball, the scam of Wall Street, the scam of Wall Street is the fee structure. All right. So put a one in the chat if we're still on the same page here. I think we're doing pretty good and we're pretty good on time so far. It says looking great, Roy. Come on, you guys know I clean up nice. If I'm gonna do an investment talk, I'm gonna do it looking as sharp as I can. All right. So let's talk about some things here. I want to make sure I go in order, and I want to make sure that this builds on itself so that we can have a solid conversation. All right, put some ones in the chat if we're all ready to go. Kevin says go Vanguard. Oh, my boy is 5 steps ahead. Vanguard is an ETF that tracks the S&P 500. Well, I mean, Vanguard is an investment firm that offers low cost and low fee ETFs. And the entire Wall Street industry was trying to destroy Vanguard because of this model, because it was going to save people a lot of money. And they just destroyed it until eventually Vanguard won. And now everybody has these low fee ETFs where instead of getting, you're making 5% a year, but the fund is taking 1%. No, no, now it's very, very low fees. And now if you're going to make 5%, you're going to make 5%. And you're able to invest in the S&P 500 without getting robbed by Wall Street every step of the way. Okay, good stuff. Okay, so let's talk about this topic. Okay, let's go through accumulation versus distribution period. So when you're investing, there's two parts of the journey. You have the accumulation period. And this I actually got when I was selling insurance products because I also have a life insurance license and I had a license to sell life insurance, health insurance, and annuities. So you guys can think of health insurance as in case anything happens to you. Life insurance is insurance against the risk that you die too soon. If you die too soon, you didn't get to retirement, you can still have this money that gets paid out. And then an annuity is the opposite of life insurance. It's a insurance against the risk you live too long. So a lot of people, they expect to live to 80. And so they do their whole financial planning to have all the money they need until 80 years old. They get to 80 and they still got 5, 7, 8 more years kicking. That individual should not go back and have to get a job or have to rely on government benefits. Instead, you can have an annuity plan, which is something that pays you out guaranteed until the day you die. So annuities are a great way to make sure that you are preparing for those kind of outsized risks. So I took this idea where there's two parts to your investing journey. There's the accumulation period, which is when you're putting money into your investments. And then there's going to be the distribution period, which is what happens once these investments reach maturity or once you reach your retirement age and these investments start paying out. So the accumulation period, here's how I think about investment specifically. And let me actually look through the comment section here. At what age should we start looking for life insurance plans? It's as soon as possible. The sooner, the better. That's the case. The sooner, the better. And I'm actually going to show the example of why you want to start doing this today and not tomorrow. Because Warren Buffett has my favorite quote. The best time to start investing was 10 years ago. The second best time is today. Okay, because the longer you put it off, the worse results that you're going to have. So the accumulation period, and this is how you can look at your timeline. My clients would always tell me, here's the life goals that I have. My job was to figure out how much money do you need to invest today in order to reach this number by this date. So when we talked about the duration and the goals and the risk tolerance, we have to take these into account where if you have a date 15 years away, let's say that some of you guys are 15 years from retirement and you wanted to start investing in a life insurance policy or an annuity, you would have to have a certain number invested over the next 15 years in order to hit this predetermined target, whatever that target might be. Okay? So when you guys go talk to an investment advisor or a wealth planner, or if you decide to do this yourself, you're going to ask yourself at this 6% return, how much money do I have to invest over the next 20 years to get this 100,000, 500,000, whatever it might be? So the accumulation period is going to be duration, how long, and it's going to be the amount, which is how much. Okay? The distribution period, there's a few things to watch out for here, which is going to be the taxes that you incur. So there's some investments where you can use money that you already paid taxes on. So you got your money from your job, you already paid taxes on it, and you can invest after-tax money into this investment. That way, when it comes to the distribution, you don't have to pay taxes on that money on the way out. There's other types of investments where you can use pre-tax money, and then you can pay the taxes during the distribution phase. Once you have a lot of money, you can pay the taxes later and defer those taxes. The benefits of those depend on your circumstance. Usually, if I'm going to invest after-tax money, it's going to be because I want to maximize the amount that's in this fund. So if I'm going to put down $10,000, or if I'm going to pay taxes on the 10,000 and then put the money in, I'll only be able to put in 6K. So if I pay the taxes first, I'll only have 6K to put in, which is going to be a lot less that will compound. If I put the whole 10K in, it's going to compound a lot faster. It's going to compound a lot bigger, but I'll just have to pay the taxes on the back end. So these are things that you guys can take into consideration when you're choosing these investments. Okay. A lot of people just say, I want to have a goal, and they'll just keep working, saving, making sacrifices, not drinking coffee, like, right, saving the $2 on coffee every day. You guys seen that book? Right? If you don't go to Starbucks every day, you're gonna have 100 grand or whatever, versus actually just figuring out the hard number. This is also how I looked at quitting my job, which is how much money do I have to accumulate during the accumulation period while I have my job, 3 years, in order to be able to quit my job, and how much are my investments going to pay me out? This is a perfect framework to figure this out. So, as part of this period, here's your considerations. Number one, how much money do you need to invest today to get the outcome? Number two, how long is the accumulation period going to have to be in order for you to actually meet those goals? Because a lot of people wanted to retire and have a beach house and take their family on annual vacations and set up a fund for their grandchildren. And I had to tell them honestly, you gotta knock one of these goals off, because it's just not going to happen. And these are tough conversations to have. Okay, but I'm going to show you something at the very end that hopefully is going to improve your optimism about your ability to achieve all these goals. Because really, if you make more money, you can invest more. That's what it all comes down to: improving your income generating ability. But if you guys are making 40, 50K a year and you did that for the rest of your life, you could still retire a millionaire with this plan. Okay? If you wait until, if you guys are in your 20s, trust me, you have all the advantage in the world. You will retire a millionaire if you follow these principles. If you're in your 30s, 40s, 50s, and you may have put off investing until then, it's still possible for you to hit your goals, but you're going to have to approach things a little bit differently. Okay? And if you waited until your 50s and 60s, it's very tough to play catch up. It's possible, but that's where you're going to have to be even more creative, skip out on some of the traditional investments, and maybe go into annuities and go into life insurance policies. All right? So the duration that's number two. Number one was how much to invest. Number three is what are your taxes and fees for this investment? Well, I guess, sorry. Number three would be choosing the right investment vehicle. Number four would be the taxes and fees. So some investments are great, but if you want, like your 401k, for example, your job is probably matching you whatever you're putting in. That's a phenomenal way to grow your wealth because you're doubling up how much you're investing every month. However, there's penalties and fees for you to take that money out. And so if you wanted to use that for real estate or to grow your personal wealth while you're accumulating this money, you can't really tap into it because they're going to charge you too much to access those funds. For people who are not that motivated, the 401k is a perfect vehicle. That's why it was invented. They used to leave people to invest for themselves. We're not going to take money. We're not going to do a 401k. Good luck, and I hope that you guys take care of yourself. How many people, what percentage of the population you guys think was actually investing for the future? It wasn't that high. All right. That's why there was a mandatory investment vehicle that was created, because most Americans would not invest in their future if given their own choice. And so the 401k is great because you don't want to touch it. I know a lot of people with 200K in their 401k or 100 grand that if they were allowed to touch it with no fees, they would touch it. So maybe that's in their best interest to have an e-liquid investment like that. But when it comes to the taxes and fees and everything, if you want to get into real estate, for example, and you want to have a fund that you can borrow from, and it's going to be in your best interest, maybe you look for an insurance policy. Because insurance policy, this whole idea that wealthy people use these products to do infinite banking, where you got money invested, you can withdraw that money, you can borrow against it, you can, and still have your investment open. That's why annuities and insurance policies have become, and life insurance policies have become the number one sort of popular wealth creation tool and sort of debt creation tool. Not financial advice. I'm gonna let you guys know this right now. Personally, that's my plan, and this is what I do, is I have three main investments that I'm gonna get into for tax reasons, and I'll walk through what those three are. Annuities and life and whole life insurance is one of those investment vehicles. And then the duration of your distribution. So number two was, how long do I have to keep saving up to reach my goals? Number five is, how long is this a retirement investment going to last me? Do I have 20 years with this fund? Is it going to run out in 22 years? Is it going to run out in 25 years? And you want to make sure that you're planning to outlive your money. Okay? You can't have your money be gone before you die, because now you're 82 with no more money coming in. You got Social Security, but you don't really have enough to really live. So insurance policies are against the risk you die too soon. You want to live to 80, you keen over at 68. Your family is going to have a ton of taxes and things to pay. Your life insurance policy will protect you at that point. If you're 80 and you got another 10 years to live, your family is either going to have to supplement you. You got kids that are 60 years old that are here paying for your lifestyle, or you have this annuity that pays you guaranteed every single month until the day you die. So if you live for 10 more years, 15 more years, they have to pay you. That's a good way to insure against these inevitable life circumstances. People are like, well, I don't really want to talk about death with my family. Like, hey, pops, if something happens to you, here's the money plate. You don't really want to have these uncomfortable conversations, but you also don't want to be in a situation where you're not taking care of your money and now people around you have to take care of you. That's an even more awkward conversation. Or somebody passes away, and instead of the whole family grieving together, the whole family is now dealing with these financial problems. That's another horrible thing that I've seen tear families apart. Who's going to pay for the funeral until this gets paid out, until this gets distributed, until the estate taxes? You don't want to be living this kind of lifestyle, people. And so this is the secrets of the wealthy. It's not about the privilege, but it's about the privilege of education. Okay? The healthier and younger that you have insurance, the better. James, 100%. They'll give you the best rate possible. Mike said, is it realistic? I'm going to retire myself from trading. Well, if you invest in the right way, yes. You got to ask yourself, what amount do you need to retire from trading? Okay, let's say that it's 500K. All right. If you take your annual expenses, let's say that you have, and I'm going to be very, very conservative here. Okay. I know some people's mortgage is way higher than this, but let's just assume it's 2,500 mortgage. You got a car payment that's 400 in this environment. Let's say you have the rest of your bills with insurance and all the other expenses and all the other bills about 1,200, and your total all-in costs for your monthly expenses just to be alive is 2,900 plus 1,200, gonna be about 41. Okay, let's just imagine that this is somebody's monthly expenses. Okay, you got a family, whatever it might be. If you're living alone, it might be lower. Hopefully it's lower. If you have a family, it might be higher. But let's just assume this. So if you're paying 4,100 a month, assuming no emergencies, that's going to be 41,000 plus 8,200. So 4,900. 49,000, excuse me. I'm just going to, all right, let this one go, guys. I know it's not the exact number. Let me just get to the point. So if you're doing 49,000 a year, how many years is this 500K going to last you before you're bust? About 10 years, right? So if you want to retire yourself from trading and you made $500,000 in payouts, okay, you got about 10 years before you have to find the next play. And then as the money starts to run out and dwindle, it's going to start, and then this is assuming that you keep your lifestyle the exact same. You're retired and now you're feeling great about yourself, but now you're living paycheck to paycheck or you're living month to month. Is this a life that you really want? Probably not. What if you're making money and you have a full-time job? Now you can improve the quality of living. Now you can start to invest as opposed to just spend. Does that make sense? So when it comes to figuring out what number you need to hit the goals, the most important thing is actually knowing what this number is. So for retirement, it would be, if I want to keep my income the same every single month, how much do I have to have invested so I can make 50K a year? If I want to keep my lifestyle the same. So people who first come up on money, they make 500,000. They start to spend from this 500,000. What I would tell them is, You need to invest 500,000 into an asset that makes you 10% every year to make this 50 grand. So now you're getting paid 50K a year to do nothing, but you still have to have the 500 grand. And it's the 500 grand doesn't go away because you're spending it. It's still there. Okay. Most investments will not yield you 10% a year. You guys get what I'm saying? So you're gonna have to find something that, unless you're finding something very risky, Bitcoin, you'll double your money every year, but you could also lose it all. So that's not really the safest investment. So you can layer in a bunch of different investments, some risky and some not, to be able to achieve this goal of hitting that number. So when you ask yourself, how much do I need to retire off trading? The question is, how much you're going to pull out of trading and invest so that your investment portfolio is paying you every year. You don't have to do nothing. Let me show you guys this example here. This is one of my favorites. If you have $1 million invested and your investment is making you 7% a year, you'll make $70,000 every year guaranteed for doing zero work for the rest of your life. Right? This is true financial freedom. I did not quit my job at Merrill Lynch just from trading. I took the money out from trading and I kept putting it into crypto. And the crypto boomed and it popped off. And that's how I was able to leave my job. Now, the crypto market could have gone to zero and I could have lost all the money I had been putting aside for 3 years because it's a very high risk investment. You guys understand the risk and reward kind of thing? It's like the riskier the investment, or sorry, the higher the reward of an investment, the higher the risk. Somebody comes to you and offers you to put your money in their fund, and they're offering you these crazy returns. You got to understand, the higher the returns, the higher the risk. These companies on Coinbase that were offering staking, where you can just park your money from Bitcoin over to, let's say, Solana, and they would pay you 20,000 a year in interest. 20,000 a year? What type of Ponzi scheme is this? Right? If the money goes bust in 3 or 4 months, you can't even be surprised. Like, you asked for that. That's how people got into these massive Ponzi schemes the last 2, 3 years in the trading space. I'm not going to mention them by name, but you guys know who I'm talking about. They were offering these 1,000% returns, right? And these guys were like, 1,000% returns. Okay, take 50 grand, take 100 grand. And then all their money goes bust and they wonder how. Okay, so accumulation distribution. We talked about those 5 considerations of this accumulation distribution period: how much to invest, the duration that you're going to have to accumulate, choosing the right investment vehicle, looking out for the taxes and fees over time, and then the duration of how long that money is supposed to last you. All right? And so you'll find that if you guys want to have a lake house in 10 years, you'll have to put down 20 or 30 grand today. If you want to get your kids to retirement, or if you want to get your kids to college and their college is 60 grand, you don't have to pay 60 grand. You can pay $5,000 to $7,000, let that grow over the kid's life. And now you have an entire tuition for them of $60,000. They don't have to take out school debt, and you only paid 5 to 7 grand. All of us have paid 5 to 7 grand for a semester. And then had we invested that money instead one time, we wouldn't have had to pay semester over semester over semester. Okay. Jess said, Roy, my salary is $2,400 a month. I'm aiming for payouts. So it doesn't really matter how much you make every month, because the difference of how much you spend and how much you keep, that's what's important. Jess, I'm going to tell you that I know people that make $1 million a year that spend 950K of it because they're idiots. Now you have 50K left. So if someone in here made 100 grand this year, not a million, you just made 100 grand this year, and you were able to keep, let's call it 60% of it, you would keep $60,000. You are now wealthier than the person who made $1 million this year. Does that make sense? Okay. So it doesn't really matter how much you make. It matters how much you keep and how much you put away. And this is how we're going to get to the next example here. So I'm going to show you guys the secret, the 4th one, or the 8th wonder of the world, which is called compound interest. So there's really only a few things that you got to watch out for when you're investing. There's going to be your initial investment, how much you're going to put in the beginning. There's going to be your monthly contribution. There's going to be the length of time that you're going to compound this money, like how many years. And there's going to be the estimated interest rate that you get. Okay. So the way I've set up this example is the interest rate that you get, this depends on the investment. Typically for the S&P 500, if you look at the average returns, okay, if you look at the S&P 500 average returns, they average at about 10% annualized returns. Some years are obviously way higher. You can, like in the '08 financial crisis, you are down horrible, right? If you're the next year, you're up 25%, 15%, 2%,
I don't
15%,
know. It's
30%. Come on, guys. 30%, 15%. This guy was groaning like this was boring. Yo, being broke fucking sucks. Go get some, matter of fact, time out. Go get some fucking coffee, everybody. Go get some coffee. This is not a class. This is not a class where you're gonna get tested on this. You're either you're gonna be a broke piece of shit for the next 40 years, or you're gonna be rich. You got two choices. It's all about education. Everybody go get some coffee, go wake yourself up, go wash your face. We're gonna come back and finish this. I'm not anybody who's tired, I don't give a shit how tired you are. Being broke is way more tiring. Working 60 hours a week is way more tiring. Go get something to drink. I'll be back. I'm gonna just hang out here for about 2 minutes and take some questions while y'all do that. I know there's a lot of you in here that are starting to fall asleep. That's why your family's gonna be fucking eating dirt because of you. Your kids are gonna ask you, hey, Pop, when the world was falling apart and there was money flying everywhere and there was people giving out all this great info, what were you doing, Pop? Like, oh, I had too many burgers last night. I was yawning. I must have missed that part of the presentation. Damn, that would have been useful to know 30 years ago. I missed that part of the presentation. Ain't nobody missing shit. Go get something to drink. Go get a coffee. Go get something to wake you up and come back here and put a one in the chat when you guys are ready to continue. Let's get it going. Isn't the S&P 500 average 10% a year? Okay, good question. My boy Nathan beat me to it. I'm putting 250 a month into S&P 500 for a retirement. When she's 40, she'll have roughly 1 mil just over. I'll show you that in just a second because the secret is if you made 14% that year, but the inflation rate, your inflation is 6%, then your actual rate of return is only going to be 7%. So you thought you were making 13% a year. You're making half of that because inflation cuts down your nominal return. Nominal is the number that you see here. It's if you added up the nominal return, but your real return is the nominal minus inflation, which gives you your real realized return. Now, there's also fees and management fees. And so let's say that your advisor takes a 1% fee. This goes down to 12.5%. The inflation rate is 6%. So your real return that year was only 6.5%. You did not make 13%. Your money is growing less than half as fast as you thought it would be. Okay. We go. Education is the key to success. Yes. And a lot of people complain. They say, like, this person had this privilege, this person had this advantage, this person had that advantage. No. You are on this call. If you're on this call, you have the advantage right now. The ball is in your court. You will never need another class like this again. You got to teach this to your children. This is how you build generational wealth. Is not even you. You might not be able to hit the goals that you want. Your children will 100% do it. Generation after generation after generational wealth, it's all about this education. A 529 plan, which is traditionally the state-sponsored plan to send your kids to school. 529, right? How many people in this chat knew what a 529 plan was before we started talking today? The make or break between the people in this country that are living with college debt and the people that are not is who opened a fucking book. Right? We're like, oh, there's no. I heard this dumbass shit the other day. Someone said there's no book on raising children because they were trying to make an example like, oh, it's so tough to raise kids and there's no playbook for it, right? Ha ha ha. No, you fucking idiots. There are books on how to raise children. Right? Generation after generation, there are books on how to do all this stuff, and people just don't read them. They want to wing life. There's books on how to have a lasting marriage. How many people in America you guys think we are reading those books? Not enough. We have a 50% divorce rate in this fucking country. So it's not about some secret this or some privilege or some this and that. It's about education. Education, right? This is at the very top. Knowledge is the great equalizer. If someone was born to a richer family, if someone was born with a privilege of height or a privilege of speed or a privilege of intelligence, or they grew up in a different environment, like they grew up at the right school, whatever, your equalizer to make up the difference is how much education you're willing to put in, the knowledge that you have versus the knowledge they have. Someone's a multimillionaire, they don't know about a 529 plan. Their kid's still costing them 100K in school fees, right? They're rich, they're a lawyer, they got $1 million, but they just took a chunk and just blew it on the money or blew it on the education versus investing $10,000 and letting that grow. Okay. All right. It seems like everybody's here. Let's get back to it. So your rate of return, and I'm going to tell you guys, the reason I mentioned Vanguard is because the easiest investment that anyone can make, instead of trying to pick stocks or trying to become the next Warren Buffett, is to invest in an index fund that tracks the S&P 500. Because as you guys can see over time, the S&P 500 annual returns are looking good. Now you'll have every once in a while, like during I think this is the crash of 78 or 74, you're down bad. Okay, you look at the '08 financial or the 2001 tech bubble, you're down 20% that year, but you'll recover it in the next 2, 3 years. In the 2008 financial crisis, you would have been down. In the down year of COVID, you would have been down. But every other year, you're up 29%, you're up 28%, you're up 13%, you're up 30% returns. So the average annual returns is about 10% for the S&P 500. Now, because of inflation and fluctuations, the average annual return is actually 6.5%. Okay, so all the geniuses out there saying that, no, though, the average return is 10%. No, no. Your nominal return is 10, your real return is 6.5. So with this example, I'm going to assume a 6.5% interest rate, which is how much money you are getting paid, or your money is growing every year. And I'm going to use two examples. So some of you guys here actually have $10,000 to invest, and some of you are going to have about $1,000 to invest. And so here's what we're going to do. I'm going to give you the $10,000 example first. So this person has $10,000 that they invest today. They contribute $300 a month, which is about $6,600 every year, which is the maximum that you can contribute to a Roth IRA. An IRA is like your 401k, but for yourself. You can do it for yourself. It's an individual retirement account. So you can invest $300 per month. And let's say that you just held it for 10 years. Okay, so some of you guys, let's say that you're 60 years old, you want to retire in 10 years. You're 60 years old on this call. And let's do the 6.5% interest rate. Over here, this says the interest rate variance, which means some years it's going to go up 4. You're going to have a little bit higher. Some years is going to be less. Okay, so I just put this as a random variance here. And I'm going to hit calculate. So in 10 years, you're going to have $67,000 from that original 10K. Now, some of you guys are thinking 10 years just to make 50 grand? That's crazy. No, no, no. It's 10 years to turn this measly $10,000 and then go 7x in the returns. Now, let's go to the next example. This individual has the same $10,000. This individual is putting $300 a month, but this person has 20 years until retirement. Okay, so they're a little bit younger. They're going to start sooner. What I'm trying to show you in this example is that the sooner you start, you're not going to have a little bit more money. You're going to have a world of a difference. Those of you guys who are young that are taking this serious, you can become a multi-millionaire when you retire off of making 40 or 50 grand a year. You can retire a multi-millionaire as long as you let this run long enough. All right, so this is 20 years. Let's go ahead and hit calculate here. So in 20 years, that $10,000 would be $175,000. Not bad, right? You can either retire with this 10 grand in savings and cash, or you can put that money somewhere and you can retire with 175,000. We're getting better. We're getting better. This individual did the same exact thing, but for 30 years. Okay, so that $10,000 is now 377,000 when they go to retire. Isn't that crazy? We keep going. This person did it for 40 years. Now they have $660,000 by the time they go to retire. And you guys can see here, like the dots, it's very slow. He has $10,000, right? It's growing, it's growing, it's growing. He got a couple 100,000. It's not until the later years that this really starts to make a difference here. Year 27, right? Year 34, year 40 here. So if you have a 10% return, like consistently every year for 40 years, it's going to be $1.8 million. But on average, it's going to be 660. Okay, these three lines, they show you the worst case scenario where you're doing 2% a year. The blue one, this dark blue one, shows you if you're doing 10% a year. And the red line is if you just have those average S&P returns for 6%. Okay? So best case scenario, you're sitting at 2 million. The most likely case scenario is you're sitting at 660,000. And the worst case scenario over the 40 years, you're sitting at 250 grand. Now, if we look at the average returns for the last 100 years on the S&P 500, we ain't hitting no 2%. So that bottom one, that's not even likely. You're either going to get the red or the dark blue. Deal? And then last but not least, we did 50 years. We did 50 years here. You got $1.5 million. Okay. So if you're 20 years old watching this, if you're 20 years old watching this and you're planning on retiring at 70, and you only have $10,000 to your whole name, and you're like, with $10,000, I can never become a millionaire. I'm going to have to go commit fraud. I'm going to have to go invest in the next biggest coin. I'm going to have to go invest in the next hot stock, find the next Apple if I want to become a millionaire at this point. No, it's all about duration. Compound interest. It just keeps compounding on itself. At the end of this scenario, the worst case scenario, you're sitting at about 390K. Most likely it's 1.5 million. And the best case scenario is $6.5 million. The difference between making 6% and making 10%. All right, look at this. The difference between making 6.5% on your investments and 10% on your investments is the difference between 6.5 M's, $6.5 million, and $1.5 million. So when your advisors or somebody who's going to be your wealth manager pushes this dark blue line and they try to promote that as being what you're going to get because the average returns are 10%, but they're not really going through the fees. They're not going through the inflation, right? Then your returns are going to look very different than what you expected. If someone's charging you 3% fees and they're taking the difference, that means they made $5 million off you over your whole life. Isn't that crazy? Okay, so duration is huge. Some of you guys are like, well, Roy, I don't even have $10,000. This is what trading is for. When you ask me, Roy, is trading going to retire me? Are you going to make $1.5 million off trading? A lot of you might not, and that's fine. You don't need to. You're still going to be richer than the traders in here that make $1.5 million. Why? Because you're investing it the right way. So trading will give you this initial capital. Trading will give you this monthly contribution amount. And the more that you have here, the bigger your retirement will look. All right, let's go to these examples of $1,000 here. Okay, this is an individual that only has $1,000. I would say only, but like you got $1,000. You only have $200 to contribute every month. So let's say that you're very, very early in your trading journey. You have a job, you got a full-time job or part-time job, and you can put $200 a month. If you did this for 30 years as a young person, with the average rate of 6.5% returns, and you calculate this, in 30 years, that $1,000, you're here, you're broke. Listen to this. That $1,000 can still become $213,000. How many of you have family members that are not wealthy? And they've been around for 30, 40, 50 years. And their excuse was, how can I ever become wealthy? I only ever made 30K at this job. I only ever made 25K at this job. How many people have made that excuse over the years? Their issue was not the income. Their issue was education. Their issue was knowledge. That $1,000, if they didn't do anything else but invest $1,000 and then 200 a month, they would have still retired with almost a quarter million. Okay. Now, what if you did this for 50 years? Okay. Can the $1,000 really do anything for you? Can the $1,000 really matter? Can you become a millionaire damn near with $1,000? The answer is yes, as long as your duration is long enough, as long as your time horizon is long enough. Y'all, is this making sense or not? Put a one in the chat if this is making sense to you, because I really need this to click. This is the secret of investing. This is what they don't want you to know. They want you to think it's about which stock you pick. They want you to think about it's about whether I go with Charles Schwab or Fidelity or Vanguard or T. Rowe Price. That's what's going to make a difference. They want you to think that it's about how risky you go with all your investing assets. Oh, I got to buy the next crypto asset or the next coin. That's not how it is. You could be dead broke. If you can put together $1,000, you can start your journey towards investing and towards long-term wealth. All right. So this is the secret. So now there's three parts to this. Number one is getting the 10,000 together. So this means that you have to have capital. Number two, you have to have the monthly contribution together. This means you have to have income. So over here, you have to have investment capital. You have to have income. So you can't just get your parents let you inherit 10 grand, right? And you're just sitting on that 10 grand and you don't have a job. No, you still need income because you still got to contribute every month. And then last but not least is to understand, or there's two more. There's the time that you're going to be holding it. And this is going to be based on your goals. If you want to send your kids to school in 18 years, how much do you have to invest in 18 years to send your kid to college? Let's play this out. Let's say the kid's college tuition is going to be $70,000. And the kid just got born, right? You just had a kid this year. Matter of fact, assume your kid is 2 years old. You guys haven't even thought about this. I just changed your life. You got 16 years to the kid's about to go to school. Or maybe not. Maybe the kid is too smart. Maybe he just doesn't have a specific, maybe his interest is not something you go to school for. It's something that you can just crush and just go be successful with. Regardless, 16 years with an interest of 6.5%. So in 16 years, if you invested this $10,000, you're going to have $123,000 to send your kid to school. No school should cost your kid 123 grand. Fucking, you're not going to go to 140 grand school for basket weaving. Okay? Now, if the kid wants to go to a specialized school like law or medicine or something, they can't. How many smart people do you guys know that couldn't go to law school or med school because they had the money? They might have had the grades, they might have had the smart for it, but no one's going to go to $250,000 in debt for this. But now you can. You don't need $100,000 to go to med school. You need $10,000 and you need to have enough knowledge. Y'all got me? So this will tell you how much you have to contribute. Now, let's say you only have 5 grand. Is this still enough? Do you guys think this is still going to be enough to send your kid to college with? Yeah, most in-state tuitions are half of this. Okay. Now, what if I don't contribute at all? The $300. I'm broke. I got 5 grand. That's all I had. I put everything I had into it. I don't want to put another dime every month at all. Now it's not that good. What if I just put in 100 a month? Now we're back in the business. Y'all see how this goes? This is nuts. It's crazy. All right. So Tony Robbins has a very good book called Money Master the Game. He mentions an example. Guys, we're about to wrap up here. We got about 5 more minutes and we're done. Tony Robbins has a book called Money Master the Game. In this book, he mentions an example of this guy that used to work for Home Depot. And what he did was he would take his check. He only ever made, I think, $34,000 a year working at Home Depot, and he retired with millions because he would reinvest all of his money. Though, first off, Shannon, how you got the camera moving like that, bro? I'm trying to have that. I'm trying to have my camera zoom in and out and shit. Bro, I gotta figure out how to do that because my stationary camera is getting kind of boring. I'm looking at over at yours, and it's like zooming in, it's zooming out, it's following people. I need that.
I think he has an iPad. iPad does that.
Damn, am I streaming off the wrong thing? All right, let's get to this example. So the guy retired a millionaire because he invested all of his money, his paycheck, into Home Depot stock. And Home Depot at the time was growing year after year, decade after decade. He was at a company that just kept growing. And he retired a multimillionaire. The guy never made more than 30 grand or 40 grand in a year. Okay? So how you invest your money is more important than how much you make. That's a very big one. And last but not least, oof. Okay, I'm going to cover this part pretty quick. This is not financial advice. This is just personally the four investment classes that I've realized have the highest wealth potential, the lowest amount of tax liability, and the most amount of benefit for wealthy people. Number one is real estate. Real estate is the best wealth creation vehicle that we've ever seen. One, because you can get paid cash flow every single month from renting out your real estate. And number two, because real estate prices constantly go up over time, and you can then have equity in the house that you can then sell. So if you have a real estate property, let's take a very simple example, your family home, a single family home. You bought it for 400 grand before the pandemic. Now it's sitting at $512,000. You have $112,000 of profit in the house sitting. It's called equity. You can roll over that equity into another real estate property using something called a 501c3 exchange, which is a nonprofit. Like basically, you're starting a nonprofit corporation and you're moving your profits from real estate property to the next without creating a taxable event. If you sold your house this year and you cashed out that $112,000 in profit, you're going to have to pay income tax on that money. No, no, that's not good. You just waited 10 years to sell the house, and now you're getting half of it is just getting taken by the government. No, no. So if you roll over the equity into another real estate property, you can take advantage of that 501c3 exemption as a nonprofit entity. You can avoid creating a liquidity event. And this is not financial advice. Please consult a licensed professional. So that's one of the biggest wealth creation vehicles today. Number two, trust funds. A trust or a charitable trust are ways to avoid a taxable event because charities are typically not taxed in the same way as an estate is, and you're able to bypass a few laws, not a few laws, but a few tax events by having a trust. So you can put your entire estate, instead of you being the owner of your estate or a company being the owner of the estate, you can have a charitable trust be the owner of your estate. And this charitable trust, then you pass that on to your children, and you can avoid a lot of the tax liability that comes with transferring your wealth from generation to generation. We already talked about nonprofits and charities, and then annuities. We talked about the annuity or the whole life insurance policies, where this is something that I want everyone to go research after this, which is whole life insurance. And basically, there's two benefits of a whole life insurance policy and annuity. Is number one, you get the benefit of in case you live too long or die too soon. Number two, there's the death benefit, where if you do pass away, there's a guaranteed amount that gets paid out to your children. There's a huge return on this because if you pay, like, I think my premiums when I first got my policy was about $100 a month. It could have been less. It could have been half if I wanted to. And my death benefit, I think, is $350,000. So I'm paying $50, $60, $70 a month, and I'm getting a guaranteed death benefit. If anything happens to me, I get hit by a bus today, that the 350 grand gets paid out to my family. That's how you want to be taking care of your family. Not like, oh, fingers crossed that I don't get hit by a bus today. Newsflash. Nobody chooses today's the day I die, right? Nobody picks. So it's fucking random. So make sure you're protecting yourself. The annuity is against the risk that you live too long. But there's two parts to an insurance policy. Number one is the guaranteed death benefit. It's guaranteed. It does not change. 350K guaranteed. On the other side, there's the cash value, which is as you're investing, the money is being put into a separately managed account. And this account on the side is actually gaining interest and is growing. The difference between your 401k and the insurance policy is that you can actually borrow against your cash value to go do real estate and all these other things, and there's way less penalties to borrow. You become your own bank. You no longer have to borrow from a bank and go get a unreasonably high interest rate. You can now borrow against your own policy through that insurance company to go do productive things with your money. Now, I would never recommend that you guys go and do this so you can go spend that money. That's how you get put in the hole big time. But if you are able to use the insurance, the cash value, then you can go and invest in your first house or your first multifamily unit real estate. You can invest in your business. You can invest in whatever is permissible. Okay. You do have to pay back the funds if you want your cash value to hold, but you don't owe the money with interest to a bank. Does that make sense? There's all these different things. All right, two last things I want to talk about. I want to talk about the steps to building your wealth. So, what's the first step? Some of you guys are like, oh, I'm going to go open a Charles Schwab account today. There's going to be steps here, which we'll talk about. But we can't even talk about investments without covering the single most important thing, which is the cash flow quadrant. Now, I don't actually like Robert Kiyosaki. I think that Rich Dad, Poor Dad was a great book, but I think that the guy has absolutely lost the plot and he's kind of a scam now. But he did develop this. I think he was the first one to develop it. I'm not 100% sure, but this is absolutely brilliant. This is absolutely brilliant. Okay, the cash flow quadrant shows the different ways that you could earn income or make money. This is in America specifically, but this also applies to most countries in the world who have a similar tax system. So the E stands for employed. This is individuals who just have an employment at a specific job. Over here, these are self-employed individuals. So you're not working for someone else, but you're still trading your labor, which is your time and your effort for money. So the employed, you guys can think about this as trading labor for money. Okay, but you're using labor for money for someone else. Okay, over here, these are business owners, and we can actually talk about big business. Now, I'm not talking about big business like you have to be in the S&P 500, but there's a difference between a small business and a big business. A small business, you can still kind of get stuck in this range of the self-employed, but a big business owner is leveraging their money and their resources for the benefit of the labor of other people in order to grow exponential, in order to really, really get a bigger return. And then over here, you have investors. All right, beautiful. So big business, they're leveraging capital for the labor of others. And then investors, they leverage their capital for the capital of others. So you're letting your money work for you. Okay. I have to color coordinate this. Awesome stuff. So the goal really is over time, you want to move from quadrant to quadrant because this is how you're going to be able to build wealth and this is how you get taxed the least. So here's the dirty thing about the American tax system. The legislation is built to incentivize behavior. So if I want you guys to get into real estate, if I am the regulators or the legislators, what I would do is I would make it more expensive for you to go get a job by taxing you a lot, and I would make it cheaper for you to go get into real estate by reducing the taxes on real estate income. So now you're looking at building wealth. You'll ask yourself, is it better for me to go get a job or better for me to go do real estate? You look at these guys getting taxed very highly, these guys not getting taxed that much, you end up doing these actions. So the government builds the tax structure to incentivize things that they need for the economy. So employees and self-employed people, they get taxed the worst. So I guess here's the easiest way to say it is that in America, labor is taxed more than capital. So if you're somebody who's using their money to their advantage versus using your labor, your time, and your effort to your advantage, you're going to get taxed less than everybody else. So what is this saying? The American tax system incentivizes people to be smart with their capital and to be a capital allocator more so than it incentivizes people to labor or work for their money. Now, a lot of life fulfillment comes from work, comes from labor itself. And so don't think that this is a path to a healthy life or to a successful life or to a happy life. This is the path to getting taxed the least and building the most wealth. Okay, so keep that in mind. So the employed person, they work for somebody else. The reason that this is limited is number one, there's high taxes. So most of you guys, you know what your tax rate is. If you're in the lower brackets, it's 27%. If you're in the higher brackets, it's upwards of 40% or more. So half your money is gone. And so people who are employed, you can have doctors here. You have lawyers here. You have a lot of people who make a lot of money, but because they're employed, they end up getting paid, they end up taking high taxes. So let me ask you guys a question. Put a 1 in the chat if you would rather be a doctor making 400K a year, but after taxes, you get to keep 200K. Because you guys know how hard a doctor has to work, throughout the year. They're always constantly on call. They're constantly on their phone. It's a tough life. Now, there's a business owner here that makes let's just call it 200K a year and pays $0 in taxes. Who's making more money? I mean, they're both technically making the same amount of money, but the person making 200K, the person making 400K will come out with the same after-tax income once this is all said and done. Does this make sense? So if you're in this quadrant here, no matter if you're the highest paid lawyer in the world, you're the highest paid engineer, you're the highest paid attorney, you're the highest paid doctor, you're the highest paid, politician, whatever it might be, you're going to get taxed to death. Now, the self-employed person, they're at least not working for someone else. And they can at least have some benefits here tax-wise where they can write off a lot of their personal expenses towards their business and all this type stuff. But they're always going to be trading their labor for money. Okay, so you'll only ever be able to grow. So let's say that you charge 1,000 an hour. You're limited at 24 hours in a day for the rest of your life. So you'll never be able to grow exponentially. You're always going to be stuck at that range. Now, the business owner, for example, can use their capital to grow. So instead of having one factory and you're working inside of the shop, I'm going to open up 5, McDonald's locations. And so McDonald's, they went out there and franchised their model because they were trying to become a big business. And so when Ray Kroc first opened the second McDonald's, or when the McDonald's brothers first had their business, they were, first Ray Kroc was employed by that company, who he used to sell ice cream machines for. Then he became self-employed when he opened the first McDonald's franchise from the McDonald's brothers. And then he became a big business owner when he realized that he could take the cash flow from this one location and open 5 or 6 separate franchises. But then the real money came for McDonald's once they became an investment company. Once they realized that their job was not to sell burgers, their job was to sell enough burgers to keep the real estate that they're sitting on. So they would go find the best real estate in America, and then they would just build a burger shop on top of it, just because you have to pay the bank every month for the property. And so you sell enough burgers to pay off the bank, and then you get to keep the real estate, which is how you make real money, because then they sell the real estate to 7-Eleven or to Starbucks or the next company that takes it over. They cash out $1 million or $2 million on the property value itself, and they go on to the next place. And they don't pay taxes on it because it's a 501c3 exchange. Okay, it's a non-taxable, as a non-profit, non-taxable exchange. They take the profits and put it into the next property. And so who's going to make the most money? It's always going to be the investors. The investors never use their own labor. They don't work on the computer. They don't do anything. What they do is they put their money in places that other people can use it, and then they will pay them a return on that money. So over time, and investors get paid the least. So let's talk about the 4 different kinds of taxes before we wrap up. Number 1, the worst, is income tax. So getting taxed based on income that you earn. You see a lot of business owners, they don't pay themselves a salary, because if you pay yourself a salary, you have to get taxed on that. So instead, what they'll do is they'll consider it a distribution, They'll consider it they'll pay themselves out in stock options because you don't get taxed on stock options. You get taxed on the profits that you make on the stock options when you go to sell it. And so Elon Musk never got paid a salary at Tesla. Instead, he just got paid in stock options. Now, what he would do is then he would go use these stocks to go get money from the bank. He would leverage them as collateral, which means he puts down a deposit with the Tesla stock, and then he gets a loan from the bank. Now, in case you guys don't know, a loan is non-taxable because it's not income. Debt is not taxable. Isn't that fucking wild? Rich people, I could take $1 billion in stock. They can go get 150 million cash from JP Morgan, and the 150 million cash is not income. It's debt, and debt is not taxable. Yeah, these guys are geniuses. All right. So the worst is the income tax. Then you have, let me see. Then you have corporate tax. And then you have capital gains. I'm going to keep it as simple as possible. Okay. So if you make 100,000 in this category, the tax rate is what was it? Let's just assume 30%. And so your tax liability is 30K. Well, actually, let me do the post-tax amount. You would have 70K. So let me actually make this example very clear, which is if you make 100,000 in a year. So if you make 100,000 this year and you're using it as income tax, like you made it using a job. And then even trading, depending on what instrument you're trading, can be considered income, which is why you have to become a self-employed business owner to try to write off some of those expenses. We'll talk about that. The average corporate tax rate for a small business making 100K is, let me actually look at the exact rate. Federal. So corporations pay a flat tax on 21%. Well, that's not true. That's the higher end. I think it's 15% if you make less than a certain amount. C corps pay taxes on a range of 15 to 30. Okay, the Inflation Reduction Act is a 15% minimum tax for corporations. So I think there was a 15% flat tax for corporations making less than a certain amount. And if you're making more than a certain amount, it was 21%. So 15% was the tax rate that we ended up paying. So that's the one I'm going to go with. So you would be left with 85,000. Now, the beautiful thing about corporate taxes is that on paper, how much money you make net matters. So if you made 100,000, but you had to pay 50K for expenses to your employees, to the business cost itself, buying new equipment, just running the business, you only made $50,000 on paper. So on paper, they only want 15% of $50,000. Okay? Which is going to be about 7 grand or something like that, right? So really, you can get away with making $93,000 that year because you were able to reduce your total taxable income by having a smart. This is not tax advice. Please consult a licensed tax professional. Okay, this is just general education for the purpose of helping you all understand how wealth creation happens. Okay, and then capital gains tax is anywhere between 5 to 15% depending on your investments. But let me actually look at the capital gains tax rates in 2023. Let me get accurate here. So from 0 to 60K, you got 0 capital gains. If you're making 45 grand to about half a mil, you got a 15% capital gains tax. So if you made all your money from capital gains, 85K. Now, anyone who's smart enough to make money from capital gains is reducing their tax liability by putting their money in non-taxable investments. So this is actually a lot lower. So what's the biggest lesson? That labor is taxed more. So basically, I'll put it this way, capital over labor, which is stupid because time is priceless. And so labor should be the most valuable thing that we have. But this is not a question of right or wrong or what we agree with or don't agree with. This is a question of understanding how the game works so that we can have the most success inside the game. Do you think Dubai is a good real estate to invest? I'm not here to give you geographical advice on which location, brother. Like think about everything I just showed you. This is a basic outline. I need you to ask yourself, do you think that I could answer a question about whether Dubai is good to invest or bad to invest in like a 5-minute convo without knowing your goals, without knowing the duration of when you want these assets, without knowing your risk tolerance, without understanding your goals? I already said goals, but without understanding your income situation? So when you're asking people for advice, if they don't have something called context about your situation, they cannot give you good advice. I might be able to say that Miami is blowing up. That doesn't mean that if it's your first time investing that you should go to Miami. You might go to Tennessee and become fucking rich because you have much more opportunities there. So understanding your goals, duration, risk tolerance should help you answer that question. How long is Dubai real estate supposed to be successful? How long can they expect this burgeoning growth in tourism? Okay, if it's only 5 years, but you want to invest for 20 years, ask yourself if you still think Dubai is going to be popping in 20 years. Okay, this is very straightforward. So, yeah, this is not a game of picking right or wrong or choosing which one is better or worse. It's a game of learning how the system works so that you can game it to your advantage. Ladies and gentlemen, put a 1 in the chat if you guys learned something today, and actually just say your biggest takeaway in the chats before we hop off. Don't hop off here without texting or typing your favorite takeaway, because listening to my voice is not going to make you rich. I'm going to be rich once we get off this call. You are not going to be rich once you get off this call unless you actually learn something. If you got on here and said, well, that was my productive work for the day, good stuff. I listened to this guy talk about boring shit. That's enough work. But if you don't fucking take steps after this to go make more money or invest more money or find the right assets, you're still going to be broke in 10 years when we're having this discussion. Put something in the chats that you guys learned. Throw a like on your way out. And I appreciate every single last one of you for making it to the end of this presentation, because I know this is not the sexy stuff, but this is the stuff that will matter, because you can make however much money you want off of trading. If you're buying the iced out watches, if you're going to put $100,000 into a supercar instead of investing the 100,000 like we showed in those examples, you're going to be the loser. All the supercar guys. Okay, some of these guys make enough money to do both. But a lot of the guys that buy their 1 or 2 supercars and try to flex on social media, had they put that $14,000 or $5,000 or $4,000 into an investment property or into an investment vehicle, they would be multi-millionaires. In 4 or 5 years, once these guys have completely burned out their incomes, because they're not making money from the brokers or from the prop firms or from any of the stuff, but they're still spending 50, 60 grand a month. The people like myself who took the 100 grand and didn't buy the Lamborghini, but invested the money instead, I will have the last laugh. I'm going to have enough money invested to go get the Bugatti. That's how you do investments. Buy more equity 2024. And let's really make some shake. Okay, money talk is sexy. All right, Gabe. So my boy's making me uncomfortable here. That investor calculator is fire. Build wealth with non-taxable avenues. Yes, depending on your situation, James. Sometimes it's better to just pay the tax up front and then just not get taxed on the back end. But you can compound a lot more if you put the full amount into an investment. Gabe said investor.gov is another takeaway. There's a compound interest calculator all over the internet. Okay, it's like a lot size calculator. Just type in an interest calculator and you'll find a million of them online. Let me look at the YouTube chat real quick, see what our takeaways were here. Nathan said, I just joined. The stream sounds like the good info. He said, thanks, Roy. Yep. I appreciate the free knowledge. There we go. It's not free. This took me years and years. I had to pay for every exam and license that I took. I had to pay with my life, working at Merrill Lynch and really just working with clients day in and day out. But this is what I was able to take away. I have so much more to learn about how life insurance can set my family up. I appreciate the mini session. Life insurance will change your life. A lot of people have this constant fear about death, or this constant fear about not leaving a legacy, or constant fear about this. Eliminate that fear today, once and for all, because life insurance and whole life insurance policies are damn near free. 50 to 80 bucks a month is fucking free. Now, there's a ton of agents that make money from selling those things. So you will all have a bunch of people hitting you up in the chats or hitting you up on LinkedIn after this. Hey, if you're interested in life insurance, here's what you got to do. Hit me up. I'll make sure you're taken care of. Whoever you deal with when it comes to these investments, don't go based off of the reputation of the company alone. Go based off of how this person makes you feel. Okay, it's the one time I'm gonna tell you guys that your intuition might work. Bring your wife. Men get finessed the most here. This is not like the car shop where men have the advantage in that field. Whatever you guys know the cliche. No, it's the exact opposite. Bring your wife to this investment meeting because she's gonna tell you and she's gonna suss out whether the person in front of you is a sleaze bag or not. Okay, she's got that meter running 100 miles an hour. That because the person can either be looking out for your best interest or can be looking out strictly for theirs. Investment professionals have to put your interest above theirs. It's called the fiduciary obligation. But a lot of these people, especially in insurance, they kind of dance around that fiduciary obligation. Okay. Tax breakdown was very helpful. I hope so. How important it is to invest now, even if it's in small amounts. Zach, if you don't take anything away from this call, it's that sooner is better. I don't care how old you are, and I don't care how much money you only have $1 and a piece of lint in your pocket. You start today, you have the advantage. You start tomorrow, you're shooting yourself in the foot. Okay. HSA accounts also have a good benefits for investments. Yes, but talk to a tax professional or a licensed financial professional to figure out which avenue is best for you. Investor, I'm going to be. Okay. You have to go from step to step. So the first step of building wealth is establishing an emergency fund and then starting to invest in insurance policies. Because if you get hurt and medical bills bankrupt you, this game is done. If you get in a car accident, you don't have insurance, and now you're stuck for 2 months, 3 months, 5 months, a whole year paying off some debt, you're screwed. If you take on too much consumer debt and you're not prioritizing your life, is that you're not screwed, but it's going to set you back from this. So understand how to take care of the steps in order. Gain cash, have an emergency fund, and then get your insurance policies in check. The second is to start putting money aside into these long-term investments. At the same time, in the step two, you need to improve your earning capacity, whether it's getting a second job, whether it's getting more hours at your job to be able to have more money to invest every month. Again, when you play around with this calculator, when you're investing 200 a month, it's one thing. Now, imagine if you're trading and you have a second shift, and now you can put 1,000 a month. Okay, look at this. The difference between 200K and $1 million over 30 years is whether you put in $200 a month or $1,000 a month. Let's do this for 10 years just to bring it back to the present. Okay. If you're investing 1,000 a month, that $1,000 could still be 165 grand. Okay. Let me see. If you can only contribute $200, you go from 165,000 down to 34,000. So the next step is you have to improve your earning capacity so that you can really, really invest on a month-by-month basis. Imagine that you guys are FTMO funded, and you have a job. So you're making 3-4 grand a month off of FTMO, and you're going to invest $1,500 a month. Okay, in 10 years, that $1,000 that you put in, plus the 15,000 a year that you're going to put in, or 18,000 a year that you're going to put in, is going to be 244,000. Now, some people ask me, how do I make 1,500 a month? Well, imagine that if you're paying for a very expensive car that you don't freaking need. Imagine if you didn't pay for that expensive car for 10 years and instead put all that money into an investment. Then you can go take this money, go put a 20, 30, 40, $50,000 down payment on your favorite car and still have all this money. There you go. David Sanchez says, Roy, as a Hispanic, 98% of my community does not know anything you just talked about on the stream. I appreciate you sharing your knowledge. Believe me, you're making a difference. I know that this is going to make a difference. And David, I appreciate the kind words. But I know this makes a difference because this is mechanics. This is not opinion. If you ignore this, it's not like you're right and I'm wrong. No, you're wrong. Right? I did this for a living with a corporation that's been around for over 100 years doing this. All right. The rich people they do this generation after generation, and they don't even think about it. And it's not just about the Hispanic community, David. 98% of America 98% of America is in this quadrant, right here. So no matter what your race is, you want to blame another race for why they have privilege and you don't, just keep in mind that the only thing stopping you from bridging that gap over your lifetime is whether you do this or not, whether you make it from one quadrant to the next and to the next. And if over your lifetime you can make it to this quadrant, your children will start here. Your children could start here. Your children could start here. All right. Now, your kids are going to be a piece of shit if they start here. So make sure that they have a job first. Okay. But this is real privilege. This is what real financial privilege looks like. David, I appreciate you for the super chat. Everyone put W David in the chats if you guys are still around. And if somebody missed this stream, just imagine missing this stream. Lord have mercy. What is somebody doing other than being on the stream this morning? Somebody tell me. Besides being hungover, what could somebody be doing this morning that is not productive? What would you guys have been doing this morning if you weren't on the stream? Tell me. Bentley says the kids' school fund. Bentley, you don't want to be in a place where your kids are in debt and they resent you. You don't want to be in a place where your kids can't go to school because they can't afford it. Bentley, you're a smart man. Your kids are going to be smart. I can already tell you. So make sure those kids have the best chance, because if they want to go to an Ivy League school or whatever, that money is not the deciding factor. I had a friend who was supposed to go to Johns Hopkins to go to school. He couldn't afford it. Imagine coming from my neighborhood and you got to go to Johns Hopkins, but you couldn't afford it. Right? So I'm really glad you took that away, Bentley. Very, very bright future for you and your children. I need to use this investment calculator to start a plan to start saving and investing. Even small gains can lead to large returns. Yes. And Roman, when you get your FTMO payouts or you get your payout from trading, this is like, if you don't know what you're going to do with it, and if you don't know the power that you have like in your hands, if you don't know that this 10,000 is going to change your life forever if you can invest it, you're going to go spend it on debt, or you're going to go spend it on bills, or you're going to spend it on conspicuous consumption. Knowing the impact of every dollar in your account is going to help you be a lot more motivated to keep filling that account and pumping it and watching it grow bigger and bigger and bigger. Gabe says day 99 out of 100. We ain't done yet. We have one more day in the year, people. This is stream number 99 out of 100 days in a row. Tomorrow's stream, tomorrow's day 100 out of 100, we're going to do something very, very big, and we're going to celebrate big time, okay? I'm truly blessed to have found this channel. Roy, you're no bullshit, a teacher, a real teacher. Everyone else advises, and you teach, brother. Thank you from the bottom of my heart. You taught me so much in such a short period. And Bentley, the best reward that you can give me is to go use this and go become wildly successful. Just to go show people that the stuff that's not sexy, that's what's going to make you successful. The stuff that nobody wants to talk about, not the supercars, not the bullshit, not the gimmicks, really just staying quiet, minding your business, having a great life and a great quality of life and mental health, and just stacking up. That is the successful life formula. Roy, what's your thoughts about the impact of a non-mortgage debt in the pursuit of investing? If it's productive, Cliffco, if it's productive business debt, I would say go for it. But in complete honesty, debt is what holds people back. Like if you don't take on any debt, okay, Cliff, if you don't take on any debt at all, and you just do this formula, this is a guaranteed success formula. Because if you keep putting your money into this fund, your life could fall apart completely. All the businesses you start could be completely in the dirt, and you'll still retire a millionaire, and you'll still retire with dignity. Okay? And so debt is going to be that wild card. If you have a guaranteed return on that debt, I would entertain it. But personally, staying away from debt is going to be a great way to ensure that you never have these issues. If you are a trader, you can avoid the debt by just making more money. So become a better trader. This is your great equalizer. Okay? I'm working, but I always have time for these calls. Yeah, Roman, ask yourself how much you're learning at work today that's going to help you get free. Your job probably wants you to stay there, brother. You're probably a killer at your job, and they want you around as long as possible. So the last thing they're going to tell you is how to move from the E over to the B. Okay? But yes, you're 100% right. This is the escape. This is what I needed to do to get out of my job, and this is what I'm doing to build my real wealth. It's not let me post another supercar and pump people to a broker. Okay? It's make money trading, make money and invest it, and then have a longer term duration approach. All right? So everybody learn the right way and learn the guaranteed path that has built generations and generations of millionaires. Can this be done in Africa? You have to do your own research. How do you get taxed in your country? How, and look, here's what you got to do, Faceless 202. Look at the wealthiest people in your society. And I'm not talking about and what part of Africa are you from actually? Let me get to this. Because some parts of Africa are different than others. If you have a robust banking infrastructure, you actually have banks. If you're in Nigeria, if you're in South Africa, if you're in Ghana, if you're in Ethiopia, if you're in Northern Africa, you can actually do this up to a certain level. If you're in Tanzania, if you're in Zimbabwe, if you're in South Sudan, if you're in a country that has a less robust banking system and there's a risk of your money maybe not being there because of currency collapse, you want to look at alternative banking institutions like maybe crypto, like maybe using an exchange as a bank because your banking system might not be robust. So understanding what region you're from is very important. You're in Ghana. Okay. Well, Ghana now has a very burgeoning investment scene. Don't look at the most successful people in your society, like the top 1 to 10 people, right? You're not going to look at Dangote. You're not going to look at the top. Look at the doctors, lawyers, investors, look at people who do international business, and then start to look at how they're investing. The top of the top, there's usually some kind of investments that are not open to us. However, if you look at the doctors, lawyers, you look at the international investors, you look at the millionaires in your society, they will give you a very clear answer about how they invest. If everyone buys real estate once they reach a certain wealth level in your country, that should tell you that real estate is the goal. If everybody starts buying gold or other type of commodities once they reach a certain level, this should tell you what you should invest in. In America, when you see immigrants come here, and I'm going to use the two communities that I respect for this specifically, I'm going to use Koreans and I'm going to use the Indian community. They understand that building a business and being a business owner pays the most. And so when you see small shops or when you see strip malls that are owned by, like you'll go to a strip mall and you'll see a Korean nail salon. And then down the street, you'll see a Korean church. And then 2 doors down, you'll see a Korean market. And then 3 doors down, you'll see a Starbucks, right? It's all in the same strip mall. This individual has realized that being a business owner and they are an investor. So they're an investor because they own the property that they work on, like they own the entire strip mall. They're a business owner because they probably own 1 or 2 of the shops in the strip mall itself. And then they're self-employed because them, their wife, their kids are probably employed under that business. They're able to take advantage of different tax benefits here based on how they saw the game. Now, people in America will complain about not having opportunity, about there not being any chances, about they're not doing this and that. And instead of figuring out the play of what to get to the next level, they're just complaining. So we don't fucking do that. So in Africa, there's going to be something that you'll realize is the consistent wealth creation vehicle. Follow the money, Faceless. Put hashtag follow the money. Hashtag follow the money on the top of your notes. Cool? James said it's almost 5 a.m. here, and now I'm fired up. James, your future just got a lot brighter, my friend. Clarity is king. Clarity is king. All right, y'all. This has been an absolute banger of a masterclass. If you enjoyed this, just imagine what the paid classes will be like over at Chart Addicts. If you guys are interested in hopping on to the live class where I teach my exact day trading strategy. So if you guys want to make that $10,000 or make that 1,000 for your initial starting investment, trading is a great way to make that money. And learning a consistent day trading strategy is a great way for you to ensure that you have the tools and the money that you need to be able to succeed in 2024. Find a great strategy like this, use it for 6 to 12 months without complaining and without looking left and right and without getting your eyes off your own paper. Just use this strategy for 12 months and watch your entire future open up. Okay? chartaddictsfx.com, hit live classes, and I'd love to see you all there. The promo or the 50% off code for the FX Summit has been extended long enough to get the final details for the VIP events, which we are still ironing out because of some details. So you still have an opportunity to get half off tickets to the FX Summit 2024 conference. Come meet me and the rest of the Forex space at the #1 conference for traders, investors, and entrepreneurs next year in Dubai. If you're broke, invest in yourself is the first step. Investing in knowledge, just like you did this morning, investing in knowledge and connections at the FX Summit will go a lot further than you just only investing in stocks or one investment. Increase your earning potential by getting around the right people. All right? Happy and safe trading, everybody. Yes, we will be streaming, but today is stream number 99 out of 100. So please leave a like on the way out. And tomorrow is going to be the 100th stream in a row to wrap up 2023. 100 streams in a row, just like this for you guys, that we have not skipped a day except for Christmas. I did skip a day. We're going to make up for it 100 days straight. It's been awesome having all of you here. Okay. Great to see you. Take it easy. Happy and safe trading this upcoming week. And I'll see you tomorrow for the Sunday market outlook. Peace. Good stuff. Chart Addicts members, proud of you all. This is 2 hours straight